followed personal finance for any length of time, you've probably heard of Dave Ramsey. And Dave Ramsey really made famous a term called the debt snowball. And really, the concept behind the debt snowball is you take payments that were paying off a previous debt and then you roll them into payments for a future debt, therefore snowballing the effect or bringing closer to the present your payoff of debt. And that was a great concept. I think it's worked for a lot of people. I'm today going to talk about what I call the early retirement tax planning snowball. And this is just a series of steps that you need to do in a set period of time, meaning right before retirement when you're in the early retirement period or right after you retire to set yourself up for success. It's underestimated when I meet with clients and talk to potential clients that these small steps can make large impacts in your plan over time. I'm Forrest Dutton. I'm the owner of Brightworks Financial Planning. I'm a certified financial planner, and I'm here today in today's video to walk you through those steps so that you understand what I mean when I say the tax planning snowball. Now, again, this is not meant to be personal financial tax or investment advice. It's just an educational video, but if you're watching this, there are portions of this that are going to apply to your exact situation in a lot of cases. Now, there's nuance to personal finance. That's why the word personal is before it. But I hope you enjoy this video. And without further ado, on to the video. All right, guys, welcome in. So today I'm going to be talking about the retirement tax planning snowball, and I've got that on my screen. So today's video is going to be a little bit shorter. I'm going to try to make it more digestible. If you've seen some of my other videos, it's going to be a little shorter, but it's still going to serve the same purpose, which is to give you education, not personal advice, but just education on how this works. And in my mind, the tax planning snowball is an important piece of any early retirees plan. So on the screen here, I have what I'm calling my snowball. At the top, we have HSA. That's your health savings account. That is probably the most underappreciated account, but a very important account to fund through and into or before early retirement. So this is something ideally that if you're watching this video and you still have 5 to 10 years from retirement, you should prioritize. And I'll show you why in a minute. On the right, cash and liquidity, also underappreciated. You need a lot of cash on the sidelines if you are retiring early, because in these early years, you can utilize that cash for flexibility and for potentially tax planning moves like conversions, etc., or living expenses. On the bottom, I have appreciated stock, use of appreciated stock. This precludes that you have funded a brokerage account, which is very important. So you need to use a donor advised fund if you're someone that likes to give, or just know how appreciated stock and giving works. And on the left, we have a diversified, efficient distribution strategy. Again, making sure that you have Roth money, brokerage money, and traditional IRA or traditional 401k money in your plan. So let's dive in here to our case. All right, so our case is going to be with Bob. Bob is age 60. He and his wife want to retire. They want to retire early, and I'm defining that as they're age 60. So they have not reached Medicare age, and this also assumes if they're before 62, they don't have Social Security. So this is an early retired couple. They want to live on $88,000. Now, of that 88, they want to give 8,000. So in reality, their living expenses are going to be actually 80,000. Now, what you're going to see on the right here is you're going to see a tale of two savers. I'm calling one column snowball, and I'm calling one no snowball. So the whole premise of the retirement tax planning snowball is you have the diversification to go about a series of steps as you approach retirement to make sure you get the most out of your tax planning and to make sure you have the most flexibility to make the moves that are most appropriate to your plan. So in the no snowball scenario, this person just hasn't saved enough in a diversified enough manner to take advantage of what I'm about to show you. On the left, that person has. So you can read these amounts. The totals are going to be 1.8 million in both cases. So this is if Bob and his wife had diversified on the left, and on the right if they had not. The other thing to mention here is in this case, Bob is going to continue part-time work through age 65. So I have a $30,000 income number. So remember this scenario. So we have the different asset classes. We have traditional 401k or IRA money. We have brokerage or taxable account money. We have a health savings account. We have liquid money, and we have a Roth total. So what do I mean when I say retirement tax planning snowball? So let me go back to the snowball and just talk you through each piece. So the health savings account. Again, you can see that this was funded on the left by Bob and his wife. They have $100,000. Great job. So in my opinion, leading up to retirement, this needs to be a prioritized account. And here's why. If you get to age 55, you can then start to make catch-up contributions in your HSA, which means that you can fund this even more aggressively than you could prior to that. Now, in addition to that, the HSA is flexible, right? So if you take qualified distributions, you can take those as long as they were for healthcare expenditures tax-free. Now, what's great is if you fund it along the way, and you had an expenditure, say there was 5 years ago, you paid for that out of your bank account, not out of your HSA account, you can keep that receipt and you can actually reimburse yourself at a later date. So the reason I want to bring this into the tax planning snowball is because when you hit 55 to 60, there's a 5 year ramp where you really can start accelerating how you're utilizing this account. And in my opinion, this would be the time to start doing things like reimbursements for expenditures that happen in the last 10, 15, 20 years. Because what you can then do is you can, if you're a high earner, assuming you hit 55 to 60, it's probably the highest earning years of your life. So what you may want to do is take that HSA money and go ahead and distribute it to you as long as you have receipts to cover and you're covered by a high deductible plan. Then you can start to do what would be called a backdoor Roth contribution because assuming you're in high working years, you're probably deferring into this traditional 401k or IRA above. But what you may want to do is go ahead and start making some backdoor Roth contributions with that HSA money because it gives you flexibility. And if you saved enough, you're still going to have this six-figure account number. That's where this Roth came from. That's why I created that. Now, if you've been a diligent saver all along and you've already been doing the backdoor Roth, then bonus. Then in that case, your excess cash flow then just goes to your brokerage account. So do you see what I mean when I say snowball? You're able to use these things together so that they really, really give you the advantage of utilizing it properly. Now, in this case, for the HSA, this couple is age 60. They're worried about healthcare, as most people would. So from age 60 to 65, how does that HSA money compare in both scenarios in terms of did they do the snowball? Did they not do the snowball? Now, in this case, what I'm going to show you is let's go ahead and look at what 2026 looks like for the premium ACA tax credits, Affordable Care Act tax credits. You probably heard this in the news or maybe on some links that you've been sent or news feeds. And basically in 2026, the subsidies now are going to hit a cliff. So if your family income in 2026 hits 400% of the federal poverty guideline, you lose the subsidy altogether. So in this case, if they're a two number for their family, basically two people, I put $88,000 in here. And this is just a calculator that gives you a US average. Again, this is not going to be state specific, but I just wanted to give you an idea. So in this case, at 88,000, if that's their modified adjusted gross income, they would be at 416% of that poverty level, which on the left column is showing you what you would pay for a silver and bronze plan. Now, in this case, this is where the tax planning snowball comes into play because if you don't do a good job with distribution of income, or maybe you only have one income source, so maybe you only had a traditional IRA, well, in that case, when you go to your tax return, that $88,000 is going to show $88,000 of income. If you don't do a good job distributing it between part-time work and IRA withdrawals, then in this case, you're paying $1,937 a month in healthcare. Well, that's probably not what Bob had in mind when he said, I'm going to retire at age 60 and live on $88,000 or $80,000, because in reality, that means per year with the no snowball, he's paying 23,244. Now, here's where this gets problematic. You've been a good saver and maybe you thought you've done a good job, but in the no snowball scenario, that $50,000 that he saved in an HSA, it's almost halved in 1 year just because we weren't smart about how we distributed our income and how we went about the subsidy process. Now, this video is not meant to be comprehensive on the subsidies. I just want to show you that that preserves if you've done a good job on the snowball. Now you're wondering, wait, why is it 0 on the left column and why is it 2324 on the right? Well, the answer is the way this income comes out in the snowball is diversified. It's not just a combination of IRA and part-time work um, flowing through to your tax return, right? All income is not created equal in terms of adjusted gross income. It's going to look differently, right? So on the left side, what I've done is if someone has done a good job, remember, the snowball is about doing multiple things either before or into retirement. So just to stop you here, the HSA has been fully funded. Great, but that's not where it ends. Basically, they don't need the HSA because they were just smart on the front end about keeping their income distributions low enough to get their modified adjusted gross below that 88, even though they're living on the same amount of money. So in this case, because they have more cash on the snowball method, so we're kind of going back here, they've done a better job saving cash. They have double what the no snowball has, right? They can afford to take $20,000. Well, guess what? That's not income. That doesn't flow through to the tax return. The only thing would be what is the interest you earned on that cash, which again, for $100,000 at 3.5%, that's roughly $3,500. That's not a lot. So they can afford to live on this cash, which doesn't flow through as aggressively to the tax return. The second thing is they don't have to take as much out of that IRA. So you may have looked at these assets first and gone, Forrest, I really like this no snowball. I like that 1.5 in the IRA. Well, in reality, it doesn't matter if the diversification outside of that is not there. I'll take column E over column F all day long. So to show you how that looks, the snowball method only has to take out 20,000. Again, so far, what's our income flow through? $20,000. What's our brokerage withdrawal? 10,000. Now, in that case, that 10,000 might not be all capital gains. It might be half. It could only be 5,000. And remember, in 2026, there's still a threshold where up to a certain point, you're going to pay 0% on those capital gains. I'm not going to go over that in this video. You can look at one of my other videos that goes into that in detail. But I would say, and then you add in the part-time work and we look at our total income and that flow through is going to be, and I'll show you, as long as you get it below 400%, you're going to see that go down to zero. I'm just going to say, what if we just got it to 80? Okay, so instead of 88, what if we just go to, there we go. See these zeros? That's a bronze plan. In 2026, a bronze plan is a high deductible health plan eligible for HSA. So what I'm trying to show you here is this all works together. The other piece here is you notice that there's a giving on the no snowball for $8,000. So I'm going to go back to our snowball. I've talked about HSA. I've talked about cash and liquidity. Let's talk about appreciated stock. So in this case, what Bob and his wife did in the snowball method would be to preload their giving. So meaning if you have appreciated stocks, maybe of that 80,000, you want to give it to a church or a charity organization. So maybe you want to give $8,000 a year. That would just be a 10% number off that 80,000. If that's the case, if you want to do that over 5 years, that's $40,000. So what you could do is take that if you have a sizable brokerage, which it looks like Bob does here, 500,000, right? So maybe that was 550 prior to retirement. So this is something he did the year before, and it's ideally best done in the highest working year. Because what a donor advised fund does is instead of taking a withdrawal from that brokerage account and then having to pay the capital gains and giving the remaining cash, you can take the appreciation and the full market value is given to the charity, and you don't have to pay the capital gains. And you can decide in a donor advised fund how the funds are distributed to the charity of your choice over time. So say you pre-funded that giving, well, all of a sudden, $8,000 just came out of your budget. So in addition to that, when you get to the snowball, you don't have to you don't have to take out that brokerage money, even though you're saying, wait, on the left, there's more brokerage withdrawal. Well, in reality, there's a higher amount too. So it's not like we're breaking the bank here by taking $10,000 out of a $500,000 brokerage. That's okay. We're going to live on that, but we're not having to do it to fund giving. That's what's happening in the no snowball method. So it's just not as efficient because number one, in the no snowball method, remember, this person is not as diversified. Their brokerage account's not near as high. So that represents a higher percentage of that account versus on the left. And then we have our part-time work, which really doesn't play into this. But So again, the bottom line here is with the retirement planning tax snowball method, you set yourself up for many additional years between, again, that I'm just using 60 to 65 in this case, but it could be longer where you have some additional tax planning available. And that's why I put in here on the snowball method, do you have additional tax planning? Yes, the answer is absolutely. With the no snowball method, you really haven't opened yourself up enough to get that done. So for this video, that's it. Wanted to keep it a little bit shorter. Hope it was helpful and actionable for you. As always, again, it's not meant to be personal tax, financial, or investment advice. It's just to educate you. Please like, comment, subscribe. I'd love to hear what you think about this and want to know if you think you're implementing the tax planning snowball, and if so, how. So with that being said, I'll see you on the next video.